Want to buy a home in small town Minnesota in 2025, but you don't have a down payment saved? In a lot of greater Minnesota communities, you may be able to buy a home with zero down using a USDA loan, also known as a Rural Development Loan. I'll show you which towns qualify, what you need for credit, what the maximum income limits are, and a few ways buyers get into properties with almost no money out of pocket. I'm never sure whether to refer to it as outstate Minnesota or greater Minnesota. I tend to prefer to think of it as greater Minnesota because it is greater. I've lived in small towns like Red Wing, Lake City, as small as Little Homer, Minnesota. So if you live in a small town in Minnesota, you know what I mean when I say it's greater Minnesota. If you live there, you might have access to one of the truly zero down programs out there. I'm Peter Lindquist. I work with a lot of home buyers throughout the state of Minnesota, and I've done so for over 30 years. I want to share some of that experience with you today. Hey, if you liked today's video, give it a thumbs up. And if you're planning on buying a home soon, do yourself a favor and get as much education as possible. Subscribe to this channel. So what is a USDA loan? It's a loan backed by the U.S. government that is designed to support growth in rural communities. Generally speaking, towns of less than 20,000 people. People often think of it because they hear the word rural, they think it's some sort of a hobby farm loan, and it's definitely not that. The big selling point to this loan is simple. It's zero down payment. It gives you lower monthly payments than FHA and is overall less expensive if you and the property qualify. So where can you use USDA loans in Minnesota? It's not for the Twin Cities. I'm going to put a link in the description below of a map that USDA provides that allows you at a glance to see where in Minnesota you can use this type of financing. To name a few, it might be Owatonna and Red Wing and Faribault, or near the Twin Cities, it's Delano and North Branch. But it's also useful to know it's not available in the Twin Cities or Rochester or the city of Duluth proper. Larger areas are excluded. In a minute, I'm going to show you how using the USDA map you can identify by specific property address if the property is eligible for USDA financing. Now, the basic qualification requirements are that it's zero down payment, but that's not to say it's zero cash out of pocket. If you want to accomplish that, you would need to negotiate with the seller to pay money towards your closing costs. Or USDA has a little used rule where if the appraisal for the property comes in higher than what you paid as a purchase price, you can use that difference to finance closing costs if you qualify. For example, if you paid $250,000 for the property and it appraised to $255,000, we could increase that loan to $255,000 and put $5,000 of your closing costs on top of the loan. The challenge there is that the appraisal doesn't happen until a couple of weeks after your purchase agreement, so you can't really count on it. That's why a lot of buyers will try to negotiate with the seller to pay money towards their closing costs. In terms of credit score, most lenders are looking for a minimum credit score of 620. But as with all loans, higher credit scores are better. You get better interest rates, and it is easier to qualify for a higher price. For example, at 620, you might qualify to purchase price of $200,000, but at 720, it might be $250,000. During your pre-approval, we do what's called a soft credit pull so that we can examine your credit and see if there's anything that you can do in the near term in order to improve your credit score, to improve the odds that you'll qualify for a bigger purchase price. And the biggest issue is that the maximum housing payment is limited to 29% of your gross income. For example, if you earn $70,000 a year, that translates into qualifying to a maximum payment of around $1,700, including taxes and insurance, and that's maybe similar to a purchase price of around $200,000. Now, the better the credit score, the more liberal that is. Don't take that as a hard and fast rule. In general, compared to other kinds of mortgage programs, that's the sticking point. The total debt to income ratio is 41%. That's more similar to other programs, but it's still a little bit more conservative. That means that the housing payment plus all other debts have to fit within 41% of your gross income. Now, unlike FHA, there are maximum household income limits, and it's important to understand how these work. While some programs simply count qualifying income, we're going to call USDA income compliance income. Here's what I mean by that. Let's say that you earn a salary of $60,000 a year, but you get commissions of $10,000 a year, and you've only received those commissions for the last 6 months. Now, we can't count those commissions in terms of you qualifying, but we do have to factor them in as compliance income. So if USDA has a maximum income limit for the area of $115,000, we need to take all of the household income to make sure that it is less than $115,000. So we're not talking about income just for the person who's on the loan, because you can do a loan in just one person's name, but we have to look at what all of the income is that's received in the household to be sure it fits within the maximum income limits provided by USDA. In that map that I'm going to show you in a minute, you'll be able to determine what the maximum income limits are for the area that you are looking to buy, because it varies by county. And one other note with this program, it's needs-based. So if you have more than 20% down cash liquid that you can use for down payment, you would not qualify for this program. If we compare USDA versus FHA in a conventional low down payment loan, if you qualify for all three, you'll see that USDA, generally speaking, wins. And that's because not only is it lower down payment, but it also achieves a lower monthly payment. That is particularly because the monthly mortgage insurance is less expensive. It currently is 0.35% of the loan amount, where FHA is typically 0.55%. That might not sound like a lot, but on a $300,000 loan, it's $50 a month. It's $600 a year. And compared to conventional financing, it really depends on what your credit score is as to whether or not it's less expensive. But conventional is not a zero down product. USDA also has a one-time fee they call a guarantee fee that can be financed on top of the loan. It's 1% of the loan amount. That's comparable to FHA that has mortgage insurance premium of 1.75% that has to get financed on top of the loan. That's almost double what USDA charges. So if you can qualify for USDA, it's going to be lower cost overall and a lower monthly payment. But I will say it's easier to qualify for both FHA and conventional than it is for USDA. And that's primarily because of their restrictive debt to income ratios. Earlier, I mentioned what kind of properties qualify. The USDA appraisal is going to be essentially similar to an FHA appraisal. So if the property wouldn't qualify for an FHA, it's not going to qualify for USDA either. Common issues are that if the house is older than 1978, that any chipping paint on the property needs to be scraped and painted prior to loan closing. That can be tricky in Minnesota, especially from November to April. If there's snow on the ground, you can't really paint it prior to closing. That involves, in that case, putting up an escrow account where the seller puts money into the account to pay a painter to get it done after closing. And then the appraisal also might call out common safety issues that might be shown on the property that may otherwise not be called out on a conventional loan appraisal. If you're buying a fixer-upper, USDA probably isn't the best tool for you, but for a normal, livable home in small town Minnesota, it is great financing. I mentioned closing costs, and those can be substantial. So let's talk about 3 or 4 different ways that you can handle those. And the most common is seller-paid closing costs. You can build closing costs into your purchase price and ask the seller to pay them. Now, not all sellers are going to do that, but it is a common strategy to deal with that issue. And then I mentioned the appraisal, but again, we don't know until typically a couple weeks into the transaction if the house appraises high enough, and then we can use that. A third way that is unlike any other type of program is that you can literally put closing costs on a credit card or some other kind of unsecured loan. USDA is unique in that way, but you do have to qualify for that as well. Another way to deal with closing costs is if you qualify for entry cost assistance from the Minnesota Housing Finance Agency, you can use that as a second mortgage that goes on top of the loan in order to offset your closing costs. For more information on that type of financing, I'm going to put a link in the description below for my video on MHFA loans, Minnesota Housing Finance Agency loans. USDA also allows a gift for those closing costs. So if you've got a family member that wants to help you in terms of buying a home, you can receive that as a gift. Or some people will take out a loan against a 401k or something like that in order to deal with the closing costs that are associated with the USDA loan. They're not any more than a traditional kind of a loan, but a lot of people, when they hear zero down, think zero cash out of pocket. It's just not the case. We have to deal with several $1,000s of closing costs in order for you to qualify to buy the home. Let's just consider an example. You're buying a home in Red Wing, Minnesota, and for $250,000, and your closing costs come in at maybe $10,000 or $11,000. Let's use $11,000. A couple of different strategies would be you could increase the purchase price to $261,000. Ask the seller to pay $11,000 towards your closing costs, or maybe you want to offer them $250,000. Ask them to pay $11,000. If you do that, your net offer to the seller is actually $239,000. So understand that you're asking for concessions that is reducing what the seller is actually getting for the property. So the seller does not look at that as a $250,000 offer. Or if you qualify for MHFA, they've got down payment assistance up to $14,000. That's currently. And so now you make the offer at $250,000, and you could use up to $11,000 of entry cost assistance to offset those $11,000 worth of closing costs. That assistance is not a grant. It is a loan. And the terms can vary anywhere from 0% interest to the same interest rate that you're getting on the first mortgage through MHFA, but it is a way to help offset those entry costs that you have in terms of getting the loan. I'll note on that part about MHFA, this is where working with a lender who offers both USDA and MHFA is important, because not all lenders work with USDA, not all lenders work with MHFA. So you need to find that magic combination of a lender like us that offers both USDA and MHFA to help you navigate that part if you want to use entry cost assistance. Let's take a look at the USDA map. Link is in the description below. When you get to this page, the first thing that you want to do is be sure that you're on single family housing guaranteed. That's where it defaults to. Click accept. Brings you to a map, and you're going to put in your property address. I'm going to put in the property address to the courthouse in Red Wing. And when you do that, it will locate where that property is. It shows that the address is located in an eligible area. Anything shaded like this is going to be eligible. If we zoom out, you're going to see where it's not eligible. And you see where it starts to be tan shaded there. As we zoom out, you're going to see that in the Twin Cities area, there is no eligibility. And Rochester, it's not. Winona, it's not. But everything that is not shaded brown is eligible. And then from here, if you want to find out what the income eligibility is, you click on that tab, and we're going to go to Minnesota, Goodhue County. We'll put in the number of people in the household. I'm going to put in one for this example. I'm going to leave these others blank for the moment. Click next. Let's say that your income is $6,000 a month. And then we click finish, and we will get to this screen, which now shows what the annual household maximum income limits are. It shows what income limit or what income you input, and that was $72,000. And the income for the program we're talking about is the guaranteed program, and that is Section 502 Guaranteed Rural Housing. That shows $130,000. So as long as your gross income for the household is lower than 130,000, then it meets USDA maximum income guidelines. So is USDA a perfect fit for you or not? It's a great fit if you are a buyer in smaller town Minnesota and your household income limits are not above that community guideline. If you don't have a huge down payment available or saved. If you've got stable income, decent credit, but just struggling with the cash to close, those are indications that USDA may be a perfect fit for you. Where it doesn't fit is, if your income is way over the income limits, you've got a lot of money available to you for cash to close. And I'm not counting 401ks in that. It's liquid cash. And it's not a good fit for major fixer-uppers or hobby farms. So income limits and eligible areas change every year with the USDA. And program rules can change at any time. So you always need to check for the current info with your mortgage lender. If you're looking for a home in greater Minnesota or western Wisconsin and you're wondering, can I do this with zero down? Reach out. I'd love to look at your application, be able to compare it to USDA guidelines and see if you qualify. Thanks for watching today. Be sure to subscribe for future videos on USDA and other programs that are going to fit for you as a home buyer.